Agribusiness. Brought to you by Bank of New Zealand. Committed to agri for more than 160 years. With over 100 agribusiness partners across the country, BNZ is local and ready to support your business through the seasons.
Mike Jones, Chief Economist at the BNZ. Are you Clarkson's Farm fan, Mike?
I was listening to it last night, believe it or not.
It is. What did you take of my summation there of it? I think it's an incredibly important piece of television. I know we're way off topic here, but yeah.
It just makes me want to revert to my roots and become a farmer. I don't think I'd be any good at it, but yeah, obviously there's some big challenges.
Yeah.
Yeah, great piece of television, and the book's good too.
Yeah, the book is good, and I just think, yes, some people loathe him, but I think it's just so important that what he's done is outlined the challenges and everyone thinks, and I know he's got a lot of money and that sort of thing, but it is highly entertaining. So yeah, I do really enjoy it. Anyway, let's get down to the serious business. CPI data out this morning, and I note this is preceding the war, right? What is it? What's happening?
Yeah, that's right. So CPI out this morning. This is our sort of quarterly update on how annual inflation is going in New Zealand. To some extent, probably not as much interest in it at the moment because, as you said, these data mostly predate the war, so kind of reference a happier time for the economy and for inflation in the first quarter of the year. But nonetheless, always something of interest for economists and markets alike, particularly as it relates to what it might mean for interest rates. So the news that came through was that CPI rose 0.9% in the quarter. So that gives us an annual read of 3.1. Now that is not too far away from expectations, but a bit stronger than we probably might have hoped for. I mean, the market had, or the consensus was at 2.9. We were, and the Reserve Bank were at 3, and in the event we got 3.1, which was the same as last quarter.
So what was that put down to, that slightly higher CPI than expected?
Well, you can cut and look at the numbers in a whole different ways. I mean, the two big real contributors were food and transport, which will, of course, surprise no one, but actually it was pretty widespread if you look at those price increases through the quarter. Yeah, so you had food, you had transport, you've got healthcare, electricity, a bunch of those sort of administrative costs as well. So, really just a continuation of that inflationary or too high inflationary environment that we've been in. And of course, the backdrop or the sort of elephant in the room is that we know in the current quarter, in the second quarter, that inflation will spike much more dramatically, probably we think to up towards 4.5%, because that's when the big lifts we've seen in fuel prices will mostly register in terms of the way stats measure it. They'll mostly come through in the second quarter numbers. So we more or less know that that's going to happen. The numbers we got today were mostly about setting the starting point, more like the curtain raiser, and even then probably a bit firmer than we would have liked.
Which is not great news, right? So based on what you've just told me then, the market, the market loves to, put in the hedge and like to look ahead. What are you hearing? What are you looking at or expecting, I suppose, by the time we're talking about this in 3 months' time?
Well, 3 months, very long time. They say a week is a long time in politics, but it's also a long time in economics at the moment, because I suppose what we are all watching is still the Iranian headlines. So it's very difficult to forecast what sort of picture we'll be in 3 months. I think, like I said, it is clear we're going to have a higher inflation by then, probably somewhere in the 4s. A lot will depend on what happens with fuel prices, of course, from here. You mentioned the markets. I mean, what they've done on today's numbers is they've actually moved a bit further to bake in potentially earlier lifts to the Reserve Bank's official cash rate. So what the markets are basically saying is, well, there's now kind of even less room on the inflation outlook for the Reserve Bank to be able to sit back and look through this big shock. They're going to have to move a bit earlier. So the markets have actually fully baked in a rate rise by July. That's not our view. We're still sitting at September, a bit later in the year. But wholesale interest rates, they're moving up on the basis of those numbers we saw today.
So have they talked about the percentage base rise? Is it 0.25 or are they going to go whole hog with 0.5? Are they starting to talk about that yet?
No, not really. It's still 0.25 is the increment, and so that's what's being factored in, a 0.25% increase in July. Not to say it will be delivered. I mean, of course, we're still in this murky environment, but that's where the markets are moving. I think, in this sort of fragile, uncertain environment, no one's really talking about bigger moves than 0.25 just yet.
It's interesting. I was in the North Island yesterday and driving around, and fuel prices, 10 days ago we were looking at diesel 410, 420. I saw it 330 yesterday at a Waitomo in Hamilton. If these prices started, if there was a resumption, or if things got resolved, could we start to, could we see this tail off quite quickly?
If we got some resolution pretty quickly, I think we could. Yeah, I think the markets have tended to take quite an optimistic view on what we might see between Iran and the US. So that's why wholesale oil and kind of refined fuel prices have come down. That's allowed, as you say, just a little bit of easing at the pump, not a lot, but some lower prices. I think will we get to get some sort of durable ceasefire? I mean, that's the key word, because fool me once, fool me twice.
Yeah.
The markets will want to see it as some sort of robust announcement, not something that might again be threatened. So yeah, I mean, that's eminently plausible, and in fact, that's what we put into our numbers when we look at inflation over the next couple of quarters. You kind of have to assume that prices could fall quite quickly. I mean, you go back to where we were kind of pre-conflict. The oil market as a whole was actually relatively well supplied. I mean, people actually talked about it being oversupplied. So it's not necessarily an issue of demand versus supply. Of course, it's just an issue about this choke point and logistics. So that's, assuming that gets resolved, I think things can normalise.
The other thing that happens too is that, you see an equilibrium start to come in, don't you? Like a new normal, a new base floor kind of gets hit. People get a little bit more comfortable with it. What about the dollar? Because that plays a big part in our export, right? If our dollar falls, what's happened with the dollar?
Well, it's up a little bit on the back of those inflation numbers I mentioned, basically because you've got the markets going, well, this might result in inflation, in interest rates being lifted a little bit earlier. That all else equal tends to boost the dollar. So it's up a little bit. Generally speaking, it's still at relatively low levels, of course. Right across the board, we're seeing kind of fresh multi-year lows against the Aussie dollar in particular. I mean, we as an economy and our interest rates have tended to underperform or underwhelm the rest of the world, and that's what's kept that currency quite low. So I think generally speaking, that story remains intact, although we are seeing some small increases.
So we are looking obviously at some interest rates going forward, and I know either farmers or homeowners will be looking to potentially fix if they can to try and take advantage of that, but we're not sure about that. The other thing is prices of imports coming into the country. The lower dollar does make them more expensive as well, so we are expecting to see that pressure even without us really being able to control it, right?
Well, that's right. I mean, the dollar's sort of the other side of a lot of fuel costs and other imported costs as well. And so it's probably been one thing that's tended to hold back, imports of things like capex, plant machinery, and so forth, being as low as it has, and it's it's probably also lifted inflation as a result, because lower currency, all else being equal, boost those import costs. I mean, our expectation, and any of these expectations and forecasts at the moment, you want to give a pretty wide berth or take a grain of salt with them, but is that the currency, the Kiwi dollar against the US, does tend to trend higher this year, not to particularly high levels overall, but as we hopefully as an economy find our feet perhaps later in the year, interest rates start to rise, we think currency will be pulled up as a result.
What about confidence then? That's the big one. It's shattered at the moment, isn't it?
Yeah, it is. And look, we got another business confidence number out just prior to the inflation numbers this morning, which showed exactly that, that confidence is through the floor, as you might expect. I mean, I hear on a daily basis from businesses saying, not only have we got that extra cost to absorb, not just from fuel, but fertilizer, a whole bunch of other stuff, plastics, resins, construction costs. So you've got the cost side, but just as much of an impact, I think, is just the uncertainty. How do you plan in this environment for even 3 or 6 months down the line when you don't know what your cost's going to look like? You don't know what the economy or demand for your product's going to look like. And I think the general mood at the moment is one of just waiting. It's a day-by-day thing, waiting, sitting on your hands. We know that there is activity that might have gone ahead that is not, because firms just don't have the confidence to push forward. They were just starting to get it a month or so ago, and it's been shattered. So I think the next the next 2, 3, 4 weeks are going to be really critical, because that's when we need to see some resolution. I think firms can hold on a bit longer, but anything, longer than that, it's going to be pretty devastating.
Mike, are we in GFC COVID sort of territory now?
No, I don't think so. Not from what we're seeing at the moment. Like I say, a lot depends on what we see over the next month. Because I mean, the big risk out of all of this, as we all know, is, okay, you've got the price impacts, but the supply impacts of fuel. So any sort of rationing or difficulty accessing supply, that is the really big risk that we're watching. Seems to be being, managed. Looks okay at the moment. That is the scenario we want to avoid. But outside of that, I don't think we are headed into those sorts of deep, dark sorts of territory you mentioned.
All right. Mike Jones, Chief Economist at BNZ. Really appreciate your time, mate. Thanks for coming on and giving us that info on the CPI numbers. We'll talk again. Thank you.
Thanks. Pleasure. See you later.
Out on the farm, the right support goes a long way. Speak to your local BNZ agribusiness partner for insight and expertise you need to farm through the seasons.